we are starting chapter 10 today. We're doing section A. And this whole chapter is about foreign currency transactions. So we're going to look at how we convert or translate transactions that are in foreign currencies to Canadian dollars. So foreign currency transactions occur when one company enters a transaction with another in a different country. If the agreement that the transaction will be settled in, if the agreement says it'll be settled in Canadian dollars, there's no risk to the Canadian company. We're assuming we're Canadian companies. And the company can enter like any domestic transaction. However, when the agreement calls for the transaction to be settled, paid, or received in a foreign currency, it's one of two things. If the transaction is a purchase, the Canadian company will have to acquire foreign currency in order to discharge the obligation resulting from its imports. So, we have to give foreign currency to the seller. On the other hand, if the transaction is a sale, the Canadian company will receive foreign currency. And we want to keep it in Canadian dollars, so we'll have to sell the foreign currency in order to receive Canadian dollars. So if it's a sale, we will get foreign currency from the purchaser. So think of yourself buying something online from a US store, a European store, an Asian store, wherever. So a lot of times you have to pay that country's currency. If you do it through PayPal or anything, credit card, it will convert at whatever the rate is on the day plus a fee, your Canadian dollars into that currency. So we're doing the same kind of thing here. How do we record it when we make a purchase or make a sale? Now, your own books at home when you're buying, let's say they're not charging your card until it's shipped, and there's a 3-day wait. Well, it's likely that you're not going to put down your order on one in your own books at home and then translate the currency every day till it actually ships and you know exactly what the currency rate is. And you're not going to record gains and losses every day. Okay? So the difference is with a company, and especially around quarter end and definitely at year end, they'll want to know what their risk level is with foreign currency transactions, so they will adjust them. Okay. The main reason that risk enters into the picture, and here remember, risk arrives because of uncertainty. So it's the uncertainty that's the problem. So accounting issues arise when the value of the Canadian dollar has changed relative to the value of the foreign currency. So we're going to look at 3 dates: the time the transaction occurs, the date financial statements are reported, so we're talking about year quarter end, and the actual settlement of the foreign currency, receivable or payable. So those are all I was going to look at. As we go through this. So recording foreign currency, I cannot talk today, dominated transactions, requires the use of exchange rates. So you guys have talked about exchange rates in finance, probably economics, different things like that. And the rates fluctuate because of the relative inflation rate between the two countries, the interest rate, the trade deficit of a country, all kinds of different things, policies that the countries put in place. And the changes are the thing that causes risk for the company because they lead to uncertainty. So this uncertainty could be favorable when it resolves or unfavorable. Till it does resolve, there's increased risk. So just to remind you from what you've learned before, an exchange rate can be expressed one of two ways. The direct rate, and this is the one you'll see the most, expresses the cost in Canadian dollars to purchase with foreign. So one US dollar is $1.34 Canadian. So take 34 Canadian to purchase one US dollar. However, you will see questions, sometimes the indirect rate, and then you've got to convert it. It's 1 Canadian dollar will buy 75 cents US. So it's the reciprocal. All you do is you divide 1 divided by 1.34 and you get 0.75. Or 1 divided by 0.75 is approximately equal to 1.34. Okay, so that's kind of a talk about risk with foreign currencies. It's about exchange rates. Now we're going to look at how we should actually translate or convert these entries. Okay, so under IFRS, individual transactions are translated into the functional currency, and we'll define that on the next page. Reporting entity. Entity can present its financial statements in any currency it wants to use, so that's the presentation currency, but on the to translate into functional currency. So the functional currency, if you look down here, is the definition. Currency of the primary economic environment in which the entity operates. So let's say we had a Canadian sub in a foreign country. Okay? So these are some of the reasons for choosing the functional currency either as the Canadian dollar or not the Canadian dollar. So, sales prices on the products it sells. If the sales occur in Canada and denominated in Canadian dollars, then they should have a functional currency of Canadian dollar. And if it's all in foreign countries, not Canadian dollars, it shouldn't be the Canadian dollar. Same kind of thing with operating costs. Labor and materials are obtained in Canada, denominated in Canadian dollars, or they're not. Competition and regulation, competitors are Canadian, or it's listed on the Canadian exchange, or it's not. And those three are more operating features. Then there's financing. Debt and equity instruments are issued in Canadian dollars, or not. And operating surpluses, excess cash is retained in Canadian dollars, or not. So these are more about control. We will go further into this, into chapter 11, but right now you just need to know that, be introduced to this topic, functional currency, the currency of the primary economic environment. How do we figure that out? We go through these 5 points and look at whether it's in Canadian dollars or not. So what we're going to do for chapter 10, recording, functional, and presentation currency equals Canadian dollars through the whole thing. So, obviously is when you're doing this. So the denomination currency is going to be foreign. So we're going to make a sale to a foreign company, and the contract has to be settled in foreign dollars or foreign currency, or a purchase same way. Because if it's in Canadian, we've done that 100 times in various other courses, so you don't need to worry about it. Okay, so this talks about the currency. Now, for accounting purposes, there are basically three rates used in translating foreign currency into reporting currency: the closing rate, the historical rate, and the forward rate. So the spot rate, which is just on any given day, that's the rate of exchange. At the end of the reporting period is called the closing rate. The spot rate on the date of transaction is the historical rate. And the agreed rate for exchange of currencies at a future date is called the forward rate. So we've got three different rates. So this talks about rates. Okay, monetary items. Now, here we're going to break all our accounts for accounting into either monetary or non-monetary. So, monetary items are units of currency held and assets and liabilities received or paid in a fixed or determinable number of units of currency. So, obviously, accounts receivable, investments, and bonds, those are monetary assets. Accounts payable, bond liabilities, monetary liability. But things like pensions, other employee benefits to be paid in cash, provisions settled in cash, cash dividends recognized as a liability are also monetary. So basically, it's the right to receive or obligation to pay in currency. And this is types of accounts. Now, that's the monetary. So obviously the non-monetary, you don't have the right for that. So on page 3, the essential feature of a non-monetary item is the absence of a right to receive or obligation to deliver the currency. So, prepaid goods and services. So, prepaid rent. You might think, well, if I can't live there anymore, they'll just give me my rent back. Or if I can't live there, I close my business. Well, a lot of times the contracts say no. You can't necessarily get cash back for that. Goodwill and tangible assets, inventories, is one that confuses people sometimes. Why do you buy inventory? Well, to sell it, right? So if you sell inventory, what are you getting? Currency. So why isn't it a monetary asset? Well, if you have that inventory,